All right. Hey, Brian. It's really nice to have you on the podcast today. Thank you so much for joining me.
Awesome. Yeah. Thanks, Matei, for having me. I appreciate it. Look forward to the conversation.
Yeah, likewise. So why don't you kick things off by telling us your life story? Who is Brian?
It's always such a big question. Yeah, I'll try to keep it high level and give you the opportunity to double click on what you think would be most relevant. But I grew up in the suburbs of Chicago. Was always interested in math, finance, science. Was definitely more left brain oriented. So through that period of my life, took me into ultimately choosing a career in finance. Did my undergrad at the University of Illinois, and then I was recruited by an investment bank in 2006, which was an interesting time. That was like probably the frothiest job market, like maybe ever in the history of time. I think I had the 35 full-time offers or something like that. So you kind of had your pick of the litter as it related to what you wanted to do. And then ultimately, I took a position with BMO Capital Markets with their investment banking group in Chicago. We were mostly doing large debt financing transactions. And a couple of years into my career, of course, we hit the great financial crisis. So it was sort of good luck, bad luck scenario where I was just way too cheap of labor and probably carrying a lot of the load that no one else wanted to do to be fired. But kind of like look over your left shoulder, look over your right shoulder, and your colleagues are dropping, kind of almost day by day. It felt like at that time. So it was an awesome period to learn, and you go through a crisis. They say I can't remember who first said it, but never waste a good crisis. And so that one was a good opportunity for me to start learning. By the time things turned around, I had started to become more senior in our business. So by 2011 and 12, really the markets had stabilized. So at the time, I was on the side, kind of doing a lot of real estate investing, just because I felt like the bottom had fallen out of that market and there was a good opportunity. It wasn't going to go away, that was for sure. So if you could, put some leverage into those transactions and just be patient, it would probably work out. Was kind of my thesis. In 2013, I was introduced to Bitcoin by a very close friend of mine, and that sort of took my life into another series of twists and turns. I kind of instantly understood the value proposition of the technology, and so I made a fairly big bet on it early on, and since then have spent a lot of time kind of studying blockchain tech and digging deeper into not just digital gold, but how can this technology be used for other purposes, and what might the future look if this is a success more broadly speaking than just digital gold. So from there to today, I've really spent the vast majority of my career in traditional finance, in banking, corporate banking, investment banking. I spent some time working for a hedge fund, which was a great experience. There's sometimes I'll speak in binaries, but there's probably two different types of hedge funds, those that are market neutral. And then there are those that are directional. And we were directional. We weren't a market neutral fund. So I had a great deal of leeway to kind of direct the portfolio in accordance with my views. So I didn't have to run a market neutral book. And we were a macro strategy inside of a traditional commodities based hedge fund. So it was kind of a new strategy for the fund. And I really fell in love with macro. And I'd say today, where I spend the vast majority of my time is directing an investment fund as it relates to specifically to blockchain tech. And then I still absolutely just love the puzzle that is macro and markets. So what I love doing is looking at the world, thinking about how the pieces fit together, and then trying to envision a future that might look different than the present, and trying to position my portfolio accordingly to capture where we think money will flow and value will accrue over time. So today, just because that's where my passion and my career kind of intersect, is where I end up spending most of my time.
I love that. And in terms of how the future fits together, going back to your childhood, you said you're interested in math and finance and science. Did you see any inklings of what your future self would end up doing? Were you investing early on? Were you interested in these novel asset classes? What were you like as a kid?
Yeah, I think I was a failed value investor, I guess you would say, as a child. At the time I had any money, I spent a couple summers just like slave labor as a caddy, just 12-hour days, a couple loops a day, and saved all the money I could. And I think I put almost all of it into United Airlines stock after September 11th on the thesis that United Airlines wasn't going away. Now, of course, the view is correct, but I didn't at that time really fully appreciate the difference between where debt and equity sit in the capital structure. So they ultimately bankrupted United Airlines and I lost all that money. So yeah, so I dabbled from a young age for sure. I was always kind of curious about gold. I wasn't like a gold bug as a child, but I always found it to be fascinating. I remember as a child like asking my father how it was possible that the government could run a deficit. Like how could we, because I couldn't conceptualize how that could work inside a household, right? Or for an individual. And it was sort of hard to conceptualize that the government had the money printer and it wasn't really quite, explained to me really well. So once I started to wrap my head around that, which was probably at a pretty young age, I sort of instantly understood the thesis for hard assets, whether that was real estate, equities, gold. So yeah, so that was helpful. I'd say, like fast forward to 2013 when I found Bitcoin, just kind of, that starting point and having those concerns and how they had compounded over the course of my life, I appreciated that certainly other people were probably thinking along the same lines that I was, and that there weren't a lot of, totally neutral assets that gave you the option to protect yourselves. So yeah, I think a little bit as a child. I think, I was more of a trial and error. I kind of still would describe myself that way. More, my approach is more trial and error than it is like I'm not likely to sit down and read a textbook, though I've read plenty. I'm much more likely to kind of dive in and make a big bet on United Airlines, lose it all, and then start digging in and learning about the difference between debt and equity and how they interplay in the capital structure.
That United Airlines bet, is that how did you come up with it? Was it something you heard while you're a caddy from people on the golf course? Did you have other friends, or did you do your own research?
I think it's funny looking at how the retail crowd, kind of trades today. I think it is a bit natural for people to be, more value investors and look for a sale and a discount. If you happen to see a crisis and an asset that you think isn't going away is on sale, there's definitely some attraction to accumulating it. I see it with investors today. It makes a ton of sense, but of course you got to really be able to see the big picture. I don't think it was that, not that I recall that anyone said anything to me. It was just that, I was reading the news and commercial air traffic had just like completely fallen off a cliff in terms of volume. No one was going through the airport. You had to take off your shoes, which was like a new thing when you went through the security line, and it was just like, and then the airline stocks just got totally bombed out. And I thought, well, they're not going to stay like this forever. Like we're going to get back on airplanes. We'll regain our comfort. We'll figure out the security thing. And so all that was right, but I lost all the money anyway. So which was was a good lesson.
What's the lesson there? I mean, you can be like wrong for the right reasons, and the markets are more complex. Like, what was the thing that you took away from that?
Yeah, I think there's, gosh, hopefully I'm remembering the name right, but I think it's Dunning-Kruger. If you've heard of the Dunning-Kruger effect, it essentially says like there's an inverse relationship between our confidence and our knowledge. So when we have a very small amount of information and a small knowledge set on something, we tend to be really highly confident. And then the more we learn about a particular thing or subject matter, we start to become experts, our confidence actually declines, right? Because we realize how complex it is and how much there is to the puzzle that we previously didn't see and understand. And we start to just appreciate this reality that the future is always uncertain. That's one of my favorite market quotes is the future is always uncertain. It is only the extent of our self-deception that changes over time. So we can fool ourselves into thinking that we know how the future is going to evolve, but we never really know. So yeah, I think at that time I was on that area of the Dunning-Kruger spectrum where I was super low knowledge, super high confidence. And so I didn't understand, the complexities of capital structure and where different creditor rights, sat within that and some of these things. So I felt like I could just buy this stock. I was young and I could wait 10 years, 20 years. Eventually it would work, right? But there was a lot that I just didn't understand or see about the big picture.
Yeah. And at the same time, like you mentioned you like just jumping into things. You're not gonna just sit on the sidelines. And if we fast forward to 2013 when you were introduced to Bitcoin, in some ways that was kind of similar. I imagine you didn't know much about it at the time. And there was a sense of like overconfidence, but that ended up obviously going well. You're very early into that game. How do you compare and contrast the Bitcoin investment versus this initial airline investment and what you think you did right, especially after your stint in investment banking? You had a lot more experience at that point. How did you approach that Bitcoin market, which is very novel, not just to you, but to everyone?
Yeah, it's a good connecting of the dots. Yeah, gosh, I've never thought about that. But I think actually probably similar in terms of just jumping into something with a lot of ignorance, but distinctly different in that I started to understand the appreciation of position sizing and diversification, right? Which is something that as a child I didn't know. So I was willing to, at whatever, 12 or 13 or 14 years old, throw all the money I had into a single stock. So by the time I was introduced to Bitcoin, the friend of mine who introduced me to it is a brilliant guy. He was an oil and gas trader at the big hedge fund Citadel in Chicago. Um, and he was someone who was doing things that I was interested in, but didn't have the knowledge and expertise. And so, I really just blindly followed him into that trade, frankly, back in 13, because, my he was that he had made a lot of good calls up until that point, and he knew a lot that I didn't understand. And if he was as excited as he was about the macro potential of this asset and how nascent it was and how early it was, that I just wanted to get involved, right? So yeah, so I think the difference was I just made I made a reasonably decent sized bet, but not bet the farm, not bet the house. So if Bitcoin had gone to zero, I wouldn't have lost everything. That's probably the biggest distinction between those two periods. If I fast forward a couple of years from there was obviously a lot of volatility, a lot of transition in the Bitcoin market between really over the 2 years that followed. Like a lot of people weren't really paying attention to the market from 2013 to 2016. 2014 was a bear market, and 15 and 16 were a reaccumulation period. It was a really quiet period for the market, and most people on the periphery just kind of assumed that the asset had gone away. And that was a period where, because I was still invested, I was watching it probably more closely. And I sort of started noticing the technical strength and the relative strength, and that got me more excited. And from there, I really started digging in and doing the work. And so it wasn't until really a few years later that I dug in and started to understand what it was. So yeah, I think it speaks to, that's kind of been my approach. Like, I don't know that that works for everyone. Everyone's got to find their own unique style, but I'm like I said, more of a trial and error oriented person. I'm much more willing to kind of jump into something, put money to work, and then start studying it. By the time, you've heard some of the greats, like, I've heard Stan Druckenmiller say this about investing. I've actually heard Jeff Bezos say this about building a new focus area within Amazon. But by the time you've got the majority of information that you need to make a decision, whether it's an investment decision or a business decision, it's probably too late, right? Either the asset has already gone up in price to your target, or one of your competitors has taken advantage of that opportunity. So sometimes you got to jump before you have all the info, and then you got to do the work on the back end, and then you got to just operate without bias and without your ego, and just really check yourself and make sure that the work that you've done after you've put money to work really confirms the validity of the thesis.
Do you remember how much Bitcoin was trading at when you first got into it in 2013?
Yes, it was just under $200. So I think my first purchase, yeah, and believe it or not, Coinbase actually existed back then. So I didn't get caught up in the Mt. Gox collapse, which was in 2014. But yeah, Coinbase existed. So I was able to open a Coinbase account, which was amazing. Link in my bank, wire some money in, and yeah, my first purchase was just a few dollars under $200. Yeah, way back in 2013.
Wow. That's amazing. And when you started doing that work on Bitcoin and the larger thesis, what did you become convinced of? How did you see the potential of this market evolving?
Yeah, so when I there's a lot to it, frankly. When I look at the future, I try to identify what are the most clear macro themes. Remember, going back to that quote I shared, the future is always uncertain, right? We can deceive ourselves, but we will never actually know the future. So ultimately, we want to construct a portfolio that can work in the widest number of unknown future scenarios. So that's kind of always my starting point. Is I start by saying I really don't know. I might, everything's a speculation to a certain extent. And so, early on, I identified two themes, which I'd say actually are as strong today as they were back in 2013, and frankly, at any point during the course of your and my life. The first was the sort of infinite expansion of the supply of money, and that once we got ourselves into a certain threshold of debt relative to our productive capacity, let's say measured in GDP, that we had kind of crossed the chasm to the point of no return. And so at that point, it didn't mean societal collapse. It didn't mean collapse of the dollar. It didn't mean some sort of crisis. Like I never really bought into that sort of like bear porn, that's out there everywhere. Instead, it was like, to me, it was just clear that the only way we were going to be able to muddle through was by, continuing to follow some of the same behaviors that got us into this problem in the first place. So absent some sort of productivity miracle, my expectation is that there will be more dollars created in 2025 than there were in 24. There were certainly more in 24 than 23. There were more in 23 than 22. We can go back, through history. And I think if you go look forward 1 year, 5 years, 10 years, this will continue to be true. And the more that we borrow from the future, the more we kind of exacerbate the problem. So that's one thing that if you can position for it, I think is probably one of the most clear things that I can speculate on about an uncertain future. And then the second was probably a little bit easier for people to wrap their arms around is technology, right? Technology just continues to evolve. It continues to enhance our productivity. If I think about just the evolution of technology through the course of your and my life, it's been really quite impressive, right? I mean, I was in grade school when the internet, started going mainstream. I think about all the application layer and how connected we are and how much that's enhanced productivity. I can extrapolate that into the potential for blockchain technology, artificial intelligence, which has a killer app and I think definitive product market fit now, and see all the ways in which technology is kind of enhancing our productivity, is enhancing, it's just growing the pie, right? So there's a bigger pie, there's a bigger value pie that we can all have a piece of or have a bigger piece of. So it's interesting because those are kind of my two core views and kind of the pockets where I've done most of my investing. And Bitcoin is this fascinating intersection between the two, right? So that's really what attracted me to it. I would say, in addition to that, appreciating that there really is only one neutral global reserve asset that exists. So if a country wants to save its wealth and it wants to do so in a way that won't be, let's say, subject to the influence of another country or foreign power, gold is really the only way to do that. And that's been the case for 5,000 years. Well, Bitcoin is all of a sudden, in some respects, a better version of gold because the supply schedule is fixed. It's easier to transport. It's infinitely divisible, and it's totally neutral, right? It's a network that can't be shut down for those that have studied it and understand how it works. So I thought that was another really interesting component of the thesis, is just the neutrality of the asset itself. And then lastly, having been a macro trader, I've traded plenty of commodities in bull and bear markets. And what's interesting about commodities is that when you want to be trading them are these rare instances where there's a supply shock. And that means essentially that there's not enough supply of the commodity. Think about oil, copper, natural gas, a precious metal, what have you. There's not enough supply to meet the demand. And so the only way you can unlock demand, unlock additional supply into that is through much higher prices. And so I've seen this play out so many times where commodities will just trade limit up, limit up, limit up for day after day, week after week, month after month. Bitcoin is, I think, very unique in the sense where if you kind of study the composition of the technicals inside of its bull markets, it has these explosive bull markets where it will just produce like a 10x return. And the reason that that's possible is because there is a limit to the supply of Bitcoin, but there's no limit to the demand in the sense that we can print an infinite amount of fiat dollars. We already sort of touched on that. And those dollars, as they flow into an asset that has a finite or limited supply, the only way you'll unlock more supply supply, it's not through the mining algorithm. We know that that doesn't change, right? Right now, we're releasing 3.125 BTC every 10 minutes, and that's not going to change for another 3 years. And at that point, it's actually going to get cut in half. So the only way you can release more supply is if you know, dramatically increase the price, which incentivizes the existing holders to release their coins. So I might hold some coins at $200 from 2013. I might have a great profit, but I might be looking at the market today and say, well, at $100,000, it's a good price, but I actually think it's worth quite a bit more. And I wouldn't even think about selling some unless it was 200,000 or 250,000. So when the market takes the price to that point, then I might say, okay, maybe I'll take a little bit of profit here. And that's how you unlock a little bit of supply. So when I put all these factors together, I just think, if you're able to be patient, handle the volatility, look out into the future a little bit, it is absolutely one of the most compelling assets. I think it continues to be one of the best trades on the board.
How do you think about that question of limited supply when it's true for that particular asset, but then you have these comparable assets that will just spring up all around it, right? And you've seen these with all these coins. I guess like Bitcoin's limited supply, but you can have like an infinite supply of other coins that some people are going to think are cool for a limited amount of time and trade up. And we've seen this in other industries as well. Like there's a big thesis now around sports investing, and part of it is limited supply. There's only, I forget what the numbers, like 150 teams between the NFL, NBA, and baseball. And that's, if everyone wants one of them and you only have that many. But then you have all these proliferation of other sports and other leagues that are springing up because of that limited supply in the core thing that attracts a lot of investors. And so, yeah, like, how do you think about these copycat assets once they see something working, they're springing up, and maybe, like, I don't know, like lessons learned from the. I was actually thinking about that in the context of gold. Like there are other precious metals. Like why is gold like that? Like why don't you have similar? Why does the world decide on picking a different rock and be like, that's the thing we all agree on is going to be the thing, and then it's got similar amount of like limited supply, and then we just all of a sudden change our mind that is the thing that we now need to hoard.
Yeah, it's a good question. Look, I think first and foremost, no matter how many copies are made and how many forks are done of the Bitcoin protocol, there still is just one original of the Bitcoin protocol. And its kind of value proposition, the thesis of those who own it, comes down to the simplicity of 21 million, which is the cap, is that you can't expand the supply of that particular version, that original version of Bitcoin, beyond 21 million. And it has a fixed and relatively well understood supply schedule. I like this idea of the wisdom of crowds. So, or, said differently, all of us are smarter than any of us, right? And, other people will say things like the market is the referee, right? Like let the market vote. And I think that's, in the long term, the market is really it is a voting mechanism. Everybody elects to put their money behind assets that they believe to have value. And at the end of the day, if you look at the vast majority of wealth, a lot of it is stored in places that have only subjective value. They have only value because humans believe that they have value. You can say that about any any precious metal, jewelry, diamonds, rare art, NFTs, collect any kind of collectible, any kind of shiny metal that we like to collect. The list goes on and on and on. And so I think there is a lot of subjectivity to where people want to store their wealth. And so that's complicated in the sense that, you'll have to understand what is the thesis that humans would subscribe to and want to purchase that thing. But historically, things that are rare and are limited in supply do tend to attract a lot of capital, and they've been a great trade. I'm a wine collector as an example. Wine has outperformed the Nasdaq over the last 25 years, which is a pretty wild statement, right? Considering it, my comments on technology from earlier. So the thing about this is, I like the market to kind of vote based on where dollars flow. So if we fork Bitcoin and we create an infinite number of copies of it with slightly tweaked parameters, et cetera, that's great. Like I encourage that. I would like to see more and more of that. And there's a lot of that happening right now. And I think that's fantastic. And over time, capital flows will, move to the winners and they'll choke out the losers. And over time, you'll get, some dominant assets for the particular use case that they serve. And so, I actually encourage that. I think it should be an open, free, competitive market. And that's something that is exciting about Bitcoin in the sense that it adds, now competition to the global neutral reserve asset bucket that was really just gold previously. And then the second part of your question, why gold? That's a great, it's a great question. Of course I can't answer that. I mean, I think it fits into this sort of, subjectivity of why we're humans attracted to it. It's kind of a pretty metal. It's shiny. It can't be destroyed. And it's relatively rare and difficult to mine. It's quite a bit more rare than silver, as we know, and the vast majority of other precious metals. So for whatever reason, it became sort of a global standard, thousands of years ago, and we've continued to use it because it just has that long history. But other than that, yeah, I can't give you a really strong explanation as to it, aside from the kind of network effect of us humans being attracted to it because it was the right color and it was shiny and it was accessible but still rare all over Earth. And because we've collected it for thousands of years and used it to store our wealth and for transactional reasons for thousands of years, it has sort of a network effect now, right? And that's something that's really powerful. Is once something is recognized as serving a specific use case and it has that network effect, it tends to become kind of entrenched, even if something that may be better comes along, right? Like we know that's true for Bitcoin. Like there's been plenty of copycats that are faster, cheaper, slightly tweaked but better technology, but no one cares, right? People want to use Bitcoin. I think it's for that same, sort of network effect reasons and its origin story. So I think there's a little bit of overlap there with gold.
You made an interesting comment about how a lot of retail investors are leaning towards value investing because it just makes sense. We're used to getting a bargain when we're buying something, so why not also get a bargain on a company? And then you hear Warren Buffett talk about these concepts. Very wealthy man, I could be like him as well. But that's not always the case, and people feel there's a lot more complexity to your point about how all this works. Even though your thesis might have been right, yes, people still need to fly, but there are lots of reasons why companies can still go bankrupt despite that overall macro thesis. I'm curious, like, how did your philosophy to investing change, especially as you've worked in different parts of finance, you've worked at a hedge fund. How is that evolution from a kid who's thinking about value investing transformed into someone that's more sophisticated and understands all these nuances?
Yeah. Well, of course, it's evolved quite a bit over the years. I think the biggest I mean, the United Airlines story is a really specific one where I think I didn't quite understand that the company could go bankrupt and the equity value would go to zero, but that United Airlines as an institution could survive that and just be restructured. So I think that was somewhat unique. Over the years, I think the biggest thing I've learned is that if you really dig in and do the work, you can actually develop a lot of conviction about a particular thesis. What I've noticed is that, and I'm not a short-term trader at all. My holding period when I worked at the hedge fund was 3 to 18 months, so that was actually quite long for a hedge fund. Now my holding period is kind of infinity. Like the longer the better, right? Because what I've realized over the years is you really want the tailwinds of compounding to start working for you. And once you start eating into your returns through transaction fees and taxes, and I think above all that, every time you make a move. So if I'm looking at, let's say, the equity market right now, and I say, oh, I don't know, tariffs, uncertainty, let me just put my money to the side, go in cash, and then when I feel like things are more stable, I'll put it back in the market. Well, that's for those who sold the bottom. You're already off. You're already off like 15% because we've had a huge bounce here, right? So every time you make a move is an opportunity to get it wrong, right? So I think, over the years, how my process has evolved is I want to, what's the most certain thing I can say about an uncertain future? We touched on that. How can I then position for it in an asset that I think will continue to accrue benefits if that thesis continues to be correct? And that allows you to really start to take advantage of the benefits of compounding, where your returns in year, it's like if you double a penny for every day for 30 days, it turns into 5 million bucks, right? We've all heard these compounding analogies where the returns just turn astronomical in the later years. So to the extent that you can make a bet and stick with it for years and frankly decades, especially for young people, I've evolved a lot to think in those terms. A couple other things I would say, that maybe I didn't appreciate when I was younger. Just one that I want to go back to because you brought up my comment around retail investors and buying the dip. And I think that's been a pretty good strategy for those that have done it in kind of a responsible way. Like if you bought S&P and NASDAQ on every dip the last, a couple of decades, you've done pretty well by now. One other thing that I've really gained a deep appreciation for, having some flexibility and some optionality for a crisis or for a kind of market shakeout event. So there's times when your thesis will be so solid that you want to be all in, and that's okay. But there's other times where, it actually helps to keep a little bit of dry powder, a little bit of liquidity, so that you can kind of deploy it into those volatile environments. There's this is probably getting pretty complex, but hopefully most of your listeners can stay with it. Like there's this thesis called the efficient market hypothesis, which many people have probably heard of. And it essentially says that prices are correct because markets are efficient. Markets reflect all the available information that's known. So prices, because they reflect all that available information, tend to be correct. And I think the only interesting thing about the efficient market hypothesis is the rare instances where it's wrong, which are extremely rare. In my trading career, we can go back to March of 20. We can go back to the 2008 financial crisis. That maybe is about it. So those are extremely rare events, and you may only see them once or twice or a handful of times in the course of a trading career. And the reason that it's wrong is because I do think for 99.9% of the time, the efficient market hypothesis is correct because people are rational and they act rationally in accordance with all the available information in the market. And that's why market prices are typically correct. But there are these rare moments where people act irrationally. Sometimes that's emotionally driven, but more times than not, it's because they're forced actors. So people might have borrowed money, they might have positions on margin. And when there's a big enough sell-off, they start to get margin calls. And if they don't have the liquidity to repost the collateral, they'll get forced out of those positions. So their brokers or their lenders will force sell their assets into the bottom of the market. And so they're not acting rationally. They want to hold on to those assets based on the information that's, they don't want to sell it at a discount. They know that this is going to be temporary. They know the government's going to come in and kind of bail us out. So I always try to keep a little bit of dry powder for those instances. And that's something that I've learned over the years because if you look at some of the great macro professionals, they've really made their entire careers on 1, 2, 3 trades, right? Like think about The Big Short and John Paulson and some of these guys who just went all in a crisis when they had a great thesis, they structured the trade properly, and they made their whole career on the back of that one trade. So yeah, that's another thing that's got some complexity to it, but keeping a little bit of dry powders. Yeah, so I think those are probably the biggest ones. This whole idea of positioning for the long term, capturing those benefits of compounding, but also having a little bit of firepower for those rare moments where markets disconnect from rational actors.
Do you think we're in an environment now where the markets are disconnecting from the rational actors?
I don't. No, I think the correction we saw after Liberation Day is very reasonable. I mean, I think the equity markets have to price in some likelihood, some percentage chance of the global world order and monetary system changing. Now, I think that's a low single digit percent, right? But it has to be priced in. I mean, markets are they think probabilistically, and they have to price in all these scenarios because remember, markets are smart, and they all the participants, when put together, their actions reflect reality, which is that the future is uncertain. Now, if the world, let's say, continues to look the way that it did over the last several decades, where the US runs a huge trade deficit, our trading partners run surpluses, and they take those surplus dollars and recycle them back into US financial assets, then we should expect moderate interest rates. We should expect equity prices to continue higher. And I think that should be the default expectation. That should be our base case for how the world continues to look. I don't think the Trump administration can reshape the global world order with the foundation that we sit on. I think there's just way too much leverage in the system today. And you can see it because they're blinking, right? They're walking back their stance on tariffs. And I think it's because there's just too much leverage both in the financial markets and in the economy to really sustain any pain for any meaningful period of time. But that said, if we're going to get a kamikaze sort of outcome where this administration is going to try to close the trade gap, balance trade, then that means that this whole trade deficit where we pushed dollars into the global system, and then those dollars were recycled through the U.S. financial account into U.S. financial assets is gonna reverse. And if that's gonna reverse, it has major implications for bonds and hence interest rates and for equities, for the valuation of equities, which are quite expensive today. So I think the market's reaction, the sell-off, was rational in the sense that it reflects having to price in some probability of that second scenario that I described. And I think as we're getting more evidence here and we're watching the administration blink, they're meeting with China today. We've got a trade deal announced with the UK, which is kind of comical because the US actually runs a surplus with the UK. But there's all sorts of signs that they're not going to push this to the kamikaze, sort of outcome two that I described. And so I think the equity market has space to recover. So I was out a couple of weeks ago with my view that I thought the equity markets had bottomed because there was enough signals that I was seeing that the administration's blinking with respect to this hard stance that they were taking on tariffs.
Does a part of you hope for the kamikaze outcome, especially as it relates to Bitcoin, right? Because this is the potentially one of the catalysts that could catalyze the whole thesis around how Bitcoin is more stable, flexible to replace the dollar as the standard.
It's a really thoughtful question. No, I don't. I don't want that. I don't want that option. I like our life here the way it is. I think it's generally, yes, I'm totally sensitive to, like, look, I look at the American working class, lower and mid income earners, hourly earners, and I totally am sympathetic. They've gotten a bad deal since the U.S. came off the gold standard in '71, and particularly since China joined the World Trade Organization in 2000. It's been just an absolute crap deal for a lot of people, and I'm hopeful that we can figure out ways to rebalance that because trickle down, hasn't proven effective, and we've got a lot of inequality in the system. And so I'm super sensitive to the constituency that supported our current administration. But generally speaking, this system is this marriage is way too deep between the US and China and globalization. And I think there's way more benefits than there are downsides to it. So both in terms of our quality of life as well as just the general state of the world, and how peaceful it is and how much bigger the pie has gotten, even if it's not fairly distributed. So I actually really don't want to see that kamikaze option. I mean, if we got that kamikaze option, I think Bitcoin at least loses 50% overnight. I mean, it should go from 100K to 50K like that, and then it probably 10x's once we just start printing loads and loads of money to try and provide enough liquidity to manage the transition of the global world order. But I don't want to see that. And what I think is going to happen instead, remember, my base case is we are going to sort of continue. The world's going to look a lot like the way that it does today. I think the Trump administration will probably get some domestic policy agenda wins. They'll probably get some slightly tweaked trade deals. I mean, you can think about what he did in 2017 around USMCA, the China deal. Like, there were some benefits to us from some of those deals. I think they'll ultimately get there, but between now and then, there's a lot of uncertainty. And while that may not play out in financial markets, it's going to play out in the real economy. I mean, if your supply chain is linked to China in any way, you're really scrambling right now. And so we should expect the real potential for recession, for two negative quarters of GDP, I think, is a real likelihood here. It doesn't mean that financial markets are going to sell off anymore, by the way. And I think because of the slowdown in the economy, we're likely to get support from policymakers, both the federal government and the Federal Reserve eventually, once they realize that this whole tariff nonsense is going to be disinflationary and not inflationary, which will take some time. Then we're going to get liquidity and support. And the impact of that liquidity and support is going to be to pump up markets, and it's going to be to stimulate the economy. And so because the equity markets in particular look 6 months ahead, 12 months ahead, they're already starting to price that in now. And so that's why I think we could have a scenario where the economy weakens, unemployment goes up, we potentially have a recession. I think that's it's not a consensus call right now, but I think there's a very real possibility of it. But that equities have already bottomed as we sit here today, because they'll be 6-12 months forward looking, and they're projecting the liquidity that's coming to help us kind of stimulate around the edges with a slowdown in the broader economy.
So say more about your the point you just made that the tariffs can actually be deflationary. Is it because it would lead to recession, and recessions are typically deflationary, or is that the mechanism?
Yeah. Yep. Exactly. Yeah. So yeah, I've studied inflation probably more than any other topic. It is really hard to get inflation without expanding the money supply, like, period. So you can get it in nuanced asset classes where there's a supply shock, right? So if all of a sudden we run into a shortage of some rare earth metal, like sure, you can get an inflation in that. But to get macro inflation, to get broad-based price increases for goods and services, you have to expand the money supply. Because remember, the circulation of dollars in the system is net zero. So if you don't expand it, then more dollars into one pocket are less dollars into another. So if we think about the economy slowing down and the implications of this uncertainty, you've got corporates that aren't going to do big capex investments here. They're not going to make big acquisitions until the environment's more clear. If they start to run into the weaker demand for their products and services, they're probably going to start laying off their employees. And so those layoffs lead to a reduction in consumer demand and retail sales, which then lead on to weaker corporate earnings, which then creates kind of a self-fulfilling sort of loop. So even though prices of goods might need to be marked up to account for the tariffs, because demand collapses, the collapse of demand is actually going to, I think, will have more of an impact than the increased prices for goods. And so what you'll see is actually excess inventories and a decline in whether or not we get a decline in prices. That rarely happens, but we'll certainly, I think we're highly unlikely to see a broad-based increase in prices of goods. And I think ultimately this is really bullish, right? Because once this becomes clear in the data dependent Fed, then they're going to have plenty of space to cut interest rates, right? I mean, the main reason that the Fed doesn't want to cut rates today is because they're concerned about inflation and that tariffs are going to exacerbate that. But if it starts to become clear in the data that we're not seeing inflationary pressures, that retail sales and consumer demand are declining, and that unemployment is starting to increase. Now, remember, the Fed has two mandates, right? Price stability and full employment. So once they see that, they'll have cover to cut rates, and this is going to be bullish for financial assets as well. So you see the equity markets start to price. They're starting to price the Fed cutting by July. That might be a little optimistic, but just depends on how the data shakes out between now and then. So yeah, it's all a lot more complicated. I think we tend to have a knee-jerk reaction to, tariffs are going to move prices up, and level one thinking that makes sense. But when you go kind of level two, level three, and think about the second and third order effects, I actually don't expect inflation. I think it'll continue to be moderate.
How do you think this is going to play across the capital structure? So we talked about equities, but what about debts and just even private credit has been a big deal now as the liquidity has dried up a little bit, and there's tons of people that are raising funds around that. How do you think about from that investment standpoint, like what are the opportunities and risks?
Yeah, it's a tricky environment for debt, no doubt. There's kind of two debt markets to think about, the public debt markets and the private debt markets. So I do think, look, I mean, theoretically, these should be good cleansing events, right? Where companies that are over leveraged, borrow too much money, can't generate free cash flow to cover their debt service, they should either go away or be restructured. Unfortunately, we rarely ever get to that point. Instead, as things get slow enough and those pressures start to build, we tend to stimulate. And I think that will be the outcome here as well. But the problem is, I just don't think the valuations make a ton of sense. So if you look at credit spreads right now, they're really tight still. So you're just not getting paid enough to compensate you for the risk that policymakers don't step in fast enough, right? And stimulate in time. And as those bankruptcies tick up, you'll start to see, value loss in bond and private credit portfolios. So I think if credit spreads were trading in double digits here, I think credit would be a great buy. But 2%, 200 basis point spreads for investment grade, and they're not even there. They're sub two. And then, junk in the kind of 4 to 6, depending on what you're talking about. It's just not enough. You're not being compensated enough, I think, for the risk that you're taking. So I don't like it as an investment here. Now, if there's another, kind of sell off in the markets and junk bonds trade to double digit spreads, then I think there'll be some selectively some value to be had there. And then I do think it's pretty complicated on the U.S. fiscal side, right? There's a lot of supply coming out of the federal government in terms of debt issuance, and it's going to be tricky to finance that. So I think in order to play the U.S. Treasury market, I really think the person you need to be paying most attention to is Scott Bessent, who's the Secretary of the Treasury, as opposed to Jerome Powell. I think if you're looking at Jerome Powell, you're probably looking at the wrong place. Bessent has a number of tools. We kind of saw what Janet Yellen did with reverse repo. She was able to push $2.5 trillion into the into the system, into the banking system effectively, which can be re-levered and rehypothecated. And that was massively stimulative. So while everyone was looking at Powell in 22 and waiting for the Fed to pivot and cut, by October of 2023, risk assets really bottomed, and the Treasury was engaged in stimulative behavior that the market didn't well understand because it wasn't called quantitative easing. Bitcoin is an example, 6x'd in that period of time. From October of 23 to today, it's up by over 6 times. And Yellen ran reverse repo from 2.5 trillion down to, I think it's sub 100 billion today. That's complicated market mechanics stuff. We can get into it if you like, but I would probably be boring your listeners. But my point is that Besant has a couple tools that look just like that as well. He can do treasury buybacks and yield curve control. So he can actually buy US government debt further out the curve with newly issued government debt and push interest rates down, which would push bond prices up. So that's one tool he has. He also has, the federal government has purview over the banking system. And so you'll see China do this more directly. In fact, they were just out yesterday and did it, where they'll change the reserve requirements for banks. And so, there's something that they're looking at now called the supplementary leverage ratio, or SLR, which basically they could tweak it. And the way they would tweak it would be to say that banks can US government debt without any equity requirement. So that means the government can issue infinite debt, the banks can buy infinite debt, and it doesn't affect the bank leverage ratios. It doesn't affect their capital ratio. So they can, once those bonds are in the banking system, they can be used as collateral. The banks now have more reserves to lend off of, and those reserves start to make their way through the economy. So that can be really, really stimulative, really impactful. So Besant actually has a ton of power that he can yield that I don't think the market is really talking much about or paying much attention to. But going back to your original question, if you see hints of any of this, I think you're going to get a massive rally in the bond market, because if the federal government basically says the banks can buy infinite bonds, well, then they can instantly fund themselves. That's QE by another name, really. And bank earnings will do really well, be great for the banks. Stronger banks mean they can lend more into the economy. It's good for the economy. So it's kind of like everybody wins, right? Except that, ultimately all these policies, like we talked about, they do tend to contribute to some inflationary pressures, at least with respect to asset prices, which over time have contributed to inequality. So it's kind of more of the same game, but those would be the signals I'd be looking at for, any kind of buy signal for the US Treasury market.
You're also, or were, a real estate investor. How do you think all this impacts the real estate markets?
Yeah, well, real estate's really stable. And I think the good thing about real estate is you can get some leverage in it relatively comfortably, right? So you can, if you own your house, you maybe only have to put up 20 cents on the dollar for your house. And so if it goes up, 5%, you just made 25% on your equity, right? Because you only put up 20 cents on the dollar. So that ability to get leverage and get it cheaply makes a ton of sense. My core view is that when we engage in stimulative behaviors, whether it's the federal government or the Federal Reserve, all that extra money is going to flow into a little bit into different pockets, different asset classes. So everything's going to benefit. So my view is real estate goes up, stocks goes up, Bitcoin goes up. So you have to ask yourself is, what is the highest beta or the most sensitive expression of that? In other words, what's going to go up by the most? And I think in that order, it's Bitcoin, tech stocks, and then real estate number 3. So I think real estate will do well. And if you have enough leverage and you get your timing right, you can compete with the returns that Bitcoin and tech stocks offer you. But I think we should expect that it delivers probably more modest returns, because everything, when you get into these periods where we're stimulating and we're expanding the money supply and we're getting more collateral into the banking system, like some of the complexities that I just described, it's good for all asset classes. It's just that on a relative basis, like, I don't know what the value of real estate is in the US, but let's just say it's like 100 trillion. Well, Bitcoin's a $2 trillion asset today. So it takes a whole lot less flow to move Bitcoin from 2 trillion to 4 trillion versus moving global real estate from 100 trillion, or US real estate from 100 trillion to 200 trillion, right? It just takes a lot more flow to move a ship of that size. So I kind of like the higher, I think they're all kind of the same trade. It's good to have a diverse portfolio unless you've got a really, you've done a lot of work and you have high conviction in your views. But I do think that's the sort of order that I would expect, which is why, as I've kind of walked through those 3 asset classes, my portfolio looks in line with that.
Yeah, and it's a good segue into what you're currently doing. You mentioned you're directing investments in the blockchain tech fund. Tell us more about that.
Yeah, so I've a simple way to think about it is I've taken that early Bitcoin vintage investment and have diversified it into other interesting uses of blockchain tech. And so, back in 2016, I was able to make a bet on Ethereum. In 2017, was able to make a bet on some other layer one competitors. And because it was early, a lot of those assets have done fairly well. That part of the market, um, people refer to as altcoins, which is really typically refer to anything that's not Bitcoin. It typically has an extremely binary views. So it's either the only place that speculative investors want to be, or it's dying and going away. It's like there's not really a whole lot of middle ground. I think right now we're coming out of the it's dying and going away phase, and it in 6 to 12 months from now, it might be the spot where most of the flows have gone, and people might look at Bitcoin and kind of scoff at the 20% or 30% year on year that it gave you because Ethereum's tripled and Solana's up 5x and what have you. So I think if we can look at certain metrics like Bitcoin dominance is probably my favorite. And you can look at crosses, right, where you look at Bitcoin relative to Ethereum or Bitcoin relative to Solana, or any of the other assets that you follow, and you can do some kind of technical analysis about what the trend looks like. But I think Bitcoin dominance gives you a really good kind of look at that as well. And right now, it's in the high 60s. People forget that in 2020, Bitcoin dominance was in the low 70s. So it's actually higher than where it is today. And a lot of the sentiment is Ethereum's dead. The Bitcoin maxis are out, like shouting from the rooftop about how right they were. And there's some hard questions that are being asked of whether or not there's much value to this technology outside of digital gold. And when I look at that sentiment, I mean, sentiment is very much so a lagging indicator. And if you invert it, it usually gives you a better signal than if you follow it. So when I invert that sentiment signal, whether the bottom is now or 6 months from now in alts, I don't know, but I think we're close. It's closer to today than it is 6 months from now. And I think it would be particularly interesting if Bitcoin dominance made a lower high here relative to the high that it made in 2020. And keep in mind, the bulk of the bull market last cycle for crypto was in 2021. I mean, Ethereum didn't top until, much later in 2021. So I think we're kind of at an interesting point where if you sort of put together my macro thesis and then you put together what I just said, I think we're going to get some support from policymakers here, both from the federal government and from the Federal Reserve eventually in the form of stimulus. And that's going to have an uneven impact on risk assets. The further out on the curve you are, the more risky, the better it will do, as long as it's, something that has real value. So we can kind of tweak the sort of three buckets that I mentioned earlier to add a fourth and call it altcoins, right? And I can say that if we're gonna engage in stimulative policies here in the next 6-12 months, which I think we are, that I would rank the best performing assets 12 months forward from now, looking backwards, as altcoins, then Bitcoin, then tech stocks, then real estate. And so if you think about what I'm doing with my personal fund, that's how I've repositioned it, is to take advantage of that.
Are there other different asset classes or things you're looking at? Like, do you always have an eye on what's next? I mean, yes, this is your point. You learned the benefits of diversification, but is there a part of you that's always hunting for the next Bitcoin, the next big thing?
Yeah. Oh, always. I talked about, look, if you can catch a multi-decade trend and stick with it, that's the golden, if you can do anything, that's what you really want to do in position for. So, but yes, I think there's some other very interesting assets out there right now. And I do think, one that I've been heavily positioned for and still think it has room to go is gold, actually. So I've spent a lot of time in the precious metals market, and I think the silver market will become interesting as well. You can think about silver like how I just described altcoins, like silver's like an alt precious metal to gold. And so we should expect that if and when the gold bull market gets just a bit more frenzied than it is today. I mean, it's gone pretty parabolic here, but I think there's still room for more flows and higher prices. We should expect that a couple of really interesting things happen. One is that silver will start to follow. Silver went to $50 an ounce in the early 1980s, and today it's trading at $33 an ounce, which is super interesting. While I don't think the thesis for silver is as strong as the thesis for gold, once you get into, kind of limit up the parabolic, blow off top phase of the gold bull market, which could last a year or longer. We might be in it now, frankly, but it could last in a year or even longer. Then you'll start to see people chase other assets that are aligned with that thesis, like silver. And then I think what we've seen in prior gold bull markets is that the gold miners, start to get repriced on a higher percentage of their gold reserves in the ground. Relative to the market cap of the equities. And I think we're starting to enter into that phase right now as well. So I am positioned for that. I think this doesn't sound that exciting because it's kind of like this different expression of my same stimulus is coming and asset prices are going to go up sort of view. But I think gold has kind of the added kicker of, look, if that kamikaze scenario plays out that we talked about, I don't think gold will lose 50% of its value. I mean, if we're going to reshape the global world order, I think Bitcoin and gold will probably separate, and gold will go to 10,000 an ounce kind of overnight. So it gives you a little bit of a hedge there. But I think in the scenario where we just do stimulus and we expand the money supply, that's an environment where gold can do well as well. So remember, uncertain future was my starting point. How can we position our portfolios to profit in the widest number of future scenarios where we don't actually know what's coming? So I really like it from that lens. And I think if we get into this kind of frenzied period, we should really
also have some exposure to like bunkers and weapons, crossbows, as you got, I mean, yeah, it's just ammo. You're buying ammo. I'm curious to go back to the beginning of your career. We're talking a lot about supply and demand. I'm curious how you think about that in the context of the labor markets. You mentioned you had 35 full-time job offers out of college. Like, that's insane, right? And then we've been in a relatively good bull market for labor for a while. And if that does start to turn, if there is the recession that you're talking about, there be some more layoffs, you're going to have graduates that don't have that kind of opportunity. And I'm curious how, first of all, I'm just curious how you made your decision with so many choices. Like, how did you choose to join BMO versus the others? And more broadly, like, what you think that level of choice, like the impact it has had on your career and the competition of other people that you're entering the labor market with. How do you think about this education, hard work, but in the context of competition with other countries? I mean, look at what's happening in China, and the level of innovation is just skyrocketing. And we also have a ton of scientists, a lot of kids focusing much more on the hard sciences than we tend to in America, especially when you weed out the international students in American universities. And one of the things that I'm kind of curious about, you mentioned AI. Like, do you think that if American kids don't want to study hard sciences as much, but they can leverage AI, will that make them as competitive as the biggest like science nerds in other countries that are gonna have to compete with each other in terms of technological innovation? Or do you think it's still just back to basics? We do also need to focus on the educational side of things, in particular in hard sciences. Kind of go back to your background, and what was interesting to you as a kid. Awesome. So you're not a bear after all. There's some light at the end of the tunnel. I love it. Well, Brian, thank you so much for joining me. This is awesome. We covered a very wide range of topics, and you made a couple of predictions, which is hard to get people to do on the record. And I appreciate that. And yeah, I look forward to seeing how all this stuff plays out. Yeah, thank you.